Welcome to the Mortgage Rate Weekly Market Update for the week of July 9th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage to give you your update. Well, hope you had a great 4th of July last week. The mortgage rates enjoyed it. They were actually able to move lower after the holiday, so we did see mortgage interest rates tick lower Thursday and Friday to end the week. If we look at the bond chart on the screen, mortgage bonds have been trading in a roller coaster pattern over the last couple weeks. We did have some good news last week. They sold off, hit a floor of support, bounced higher, and then on Friday were able to end the week with that green candle breaking through the 100-day moving average and a technical trading level called a Fibonacci level. So that was good news there. We closed above that, so we're going to recommend carefully floating your mortgage interest rate to start the week to see if it can build on that trend. Now, if it falls back below that 100-day moving average and the Fibonacci level, we would switch to a locking stance for anyone closing in the next 30 days because it looks like on Monday as the market opens, it could drop back below that. But if it closes above it on Monday, that would be a very good sign, and we would continue a floating stance. But if we close below it on Monday, I would definitely lock anything over the next 30 days. If you're out further than 30 days, you could float to see how we play around this level. But if you're in the next 30 days, if we close below that level, go ahead and lock it in. Now, if we dig into the economic news, we had the jobs report for June 2018 released on Friday by the Labor Department, and it showed 213,000 jobs created, which was more than expected. We were only expecting 190,000 jobs, so that was a good report. And also the previous 2 months, April and May, were revised higher by a combined 37,000 jobs. So good news there on the surface of the jobs report. Now, there's actually two different surveys within the jobs report that gives them some different information. There's the business survey, which is the headline jobs figure of 213,000, and there's the household survey, which is used for the unemployment rate. Now, the household survey showed there was only 120,000 jobs created. At the same time, the labor force increased by 601,000. That's the number of people being counted in the labor force. So because of that, we saw the unemployment rate actually tick up from 3.8 to 4%. And that was because more people entered the workforce than jobs were created. So we saw the unemployment number tick up. Not a bad thing. More people are coming back in the workforce looking for jobs now that unemployment has been so low for so long. The labor force participation rate, the LFPR, supports that. It increased from 62.7 to 62.9%. And then the U6 unemployment number, which measures total unemployment, includes the total unemployed plus all people marginally attached to the labor force plus part-time employees. That increased from 7.6% to 7.8%, and again, that's because we have more people we're counting in the labor force. In the report, we saw average hourly earnings showed that we don't have any wage inflation going on. It was up only 2.2% versus expectation of 0.3%, and year-over-year average wage earnings is only up 2.7%. That was bond-friendly news in the report on Friday. That's what helped us break above that. So without wage inflation, we're not going to see a lot of inflation, so that would be good news for mortgage bonds. Then we saw weak initial jobless claims come out on Thursday. Claims did move up 3,000 to 231,000 claims for the week. Even though we had a gradual increase in initial jobless claims, the pace of firings remains extremely low and well below the 300,000 mark, so that's a great sign for the labor market. We're seeing employers hold on to good employees, not letting people go, and hiring good people when they find them. Now, housing news. We got some good news there. CoreLogic Home Price Index for May 2018 showed home prices rose 1.1% from April and are up 7.1% year over year from May of 2018. Now, the 7.1% appreciation is stronger than April's 6.9%, and it's the strongest figure in 4 years. CoreLogic's predicting a 5.1% increase in home prices from May of this year to May of 2019, and that's on a national level. The big driver for home prices going up and continuing to go up is still a shortage of inventory and the fact that despite high home prices, renters still want to get out of their rental property and into owning a home. And that was according to chief economist at CoreLogic, Frank Nothoff. He basically said that 4 times as many renters were looking to buy a home than homeowners were willing to sell. This fact will likely exacerbate the supply issue and continue to support home prices. So 4 renters to 1 home seller, that's price pressure. We're going to keep seeing home prices move up because of that. But renters still know the value of owning a home, the long-term consequences of building wells, the tax implications. So it still makes sense to purchase a home, and rates are still comparatively low to the last 30-year average of 8.25%. Now, if we dig into the local market, in Newcastle County through June 2018, median home price was $244,440. The appreciation rate over the last 1 year was 4.02%. That's very good. The 5-year appreciation is 22.62%, and over the last 43 years, we saw 4.1% appreciation on average. So that's why real estate is a good investment over the long term. You will make money. Now, the forecast of appreciation over the next 5 years is $55,300 price movement on a median home of $244,000. That's why you buy a home. Over the next 5 years, just paying your mortgage payment instead of paying your rent payment, you will net $55,300 on average home price appreciation. Now, if we look at Kent County, median home price there is $206,740. Average appreciation 1 year is 3.89%, 5 years is 17.53%, and over the last 43 years, the total average was 3.69%. And the forecast of appreciation based on that median home price of $206,740 would be $36,240 of home price appreciation over 5 years just by making your mortgage payment instead of making a rent payment. Now, if we jump into Sussex County, really good there. Median home price, highest of the 3 counties, $261,170. 1 year appreciation, 8.53%. That market's on fire. 5 years, 40.15%, and the 43 years, 3.91%. So forecast appreciation over the next 5 years on that median of 261 is $104,870. That's why you want to buy a home, not rent. Cool. If we dig into the local news, we've got the next free first-time homebuyer seminar, Wednesday, July 18th, from 6 to 8 p.m. in Wilmington, Delaware, at Independence Mall at eXp Realty office. And then we're back in Newark on Saturday, July 28th from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for either one of those events, but give us a call in the office, 302-703-0727, or go online, www.delawarehomebuyerseminar.com. If you guys need a mortgage or a pre-approval, we'd love to help you out, DelawareMortgageLoans.net, or give us a call in the office. See you guys next week.